For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning and welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name's Jeff Shade, and as always, I'm just here to ask the questions for you. But the words of wisdom and solid advice, of course, they come from Randy and Jake Floyd of Floyd Financial Group. Randy is still off this week on vacation, so Jake, how you doing this Saturday?
I'm doing great, Jeff. Thank you for asking.
Certainly welcome, my friend. I hope everybody else is having a great Saturday, too. We've got a lot of great information for you. I really enjoy these Saturday mornings getting together with you, Jake, here on the radio and all the fine people here of the last bastion of sanity, Springfield, Missouri. So let's start off with a few things in current events here. I understand that Starbucks is getting a new CEO. What's that all about?
Yeah, so recently, Mr. Brian Niccol, who was the previous head over at Chipotle, which, if you're a millennial, you probably love Chipotle. Personally, I think that's okay, but they seem to have taken the world by storm. And a lot of people like the job that he has done over at Chipotle, so they have recently poached him, is the industry term that we like to, where they've stolen him away from Chipotle as the new Starbucks CEO. Starbucks has been having a hard time continuing to grow. A lot of people think it's the leadership of the company. Mm-hmm. I think it's because there's a Starbucks on every corner, but What do I know?
Well, it seems to be interesting that Starbucks has poached the CEO, but he lives in Southern California. I didn't read a lot about this. He lives in Southern California, but as I recall, Starbucks is in Seattle. So how does that work?
Right, so he's going to do something called super commuting, where he's going to travel 1,000 miles to work to and from every day. And so he's going to fly via private corporate jet 2.5 hours north, and then work, and then come home 2.5 hours south. Now, the last time I checked, Starbucks was one of the green companies out there, right, trying to save the world by instead of having plastic straws wrapped in paper, now we have paper straws wrapped in plastic. I'm not sure that we made a lot of progress there, but
no.
This is one of those companies constantly championing saving the environment, and this guy's going to burn more fuel in a day than the average person does in a year.
Well, I guess when it comes right down to it, money is money, and if they think that Mr. Nichols can make them more money, they're going to go with that. But I've never seen a lack of customers at a Starbucks.
Yeah, for the most part, Starbucks, that's probably the biggest reason I never go there.
Yeah.
Other than their overall politics and that kind of thing. It's a 30-minute wait to go to a Starbucks.
I'm not a coffee connoisseur. I mean, McDonald's coffee's fine with me for $1. Even gas station coffee will do if I have to. But yeah, I mean, it's just one of those things. I think that younger people, it's become part of their lives. They've got to go to Starbucks. I've got a niece, and we were talking over the weekend, and she's at Starbucks twice a day. We were talking about this X podcast type of thing with Donald Trump and Elon Musk. Apparently, they have been thinking about a little sort of an arrangement that they could work together.
Yeah, so during the podcast, or I guess let's call it Spaces, that's what it actually is on X.com. Elon had mentioned to Trump that he would entertain heading up a spending accountability committee, I guess, for Congress or for the government to make sure that money is getting spent where it's supposed to get spent. Now, there's already a Senate committee that's supposed to be doing that that's clearly falling down on the job. But since then, Trump came out and said that he might have a cabinet spot for Elon. And so I think it'll be interesting to see where he ends up if he accepts, and a lot of other things. Now, Trump is also going to likely end the EV tax credit, which if he does, that obviously hurts Elon and his business endeavors. So there may be some room for some disdain there before it's all said and done. However, Elon seems to understand what a lot of other people don't, which is that if we do not elect Donald Trump, that means we elect Joe Biden, Kamala Harris, or Obama surrogate, insert name here. And if that happens, way bigger things are at stake. And so even if you are not the biggest Trump fan, I think that Elon is saying that you still have to elect him because we cannot afford to have the other.
Well, Elon sort of wants an accountability office as far as the budget goes, and I think we certainly have that. But is there an oversight committee right now that keeps track of what we're spending? It seems like it's just, spend willy-nilly as wild as you want.
That's certainly what it seems like. Now, I know there are congressional committees that are supposed to be in charge of making sure that money goes where it's supposed to go. However, we continually see things like the Harris campaign getting celebrities to do her opening ceremonies and all this kind of thing. Where is that money coming from? I doubt it's Kamala Harris's pocket.
No.
And I think if we were to see the accounting on that, we'd find that taxpayers are paying for that. I also think that there's just a lot of spending, and I don't have to go down the list here on the air because I know a lot of people listening are just as upset about it as I am. But there's a lot of money that gets spent on stuff that is just stupid. And I think that Elon's tired of seeing that as well. We have lots of tax revenue already in this country, but what we have even more of is lots of tax dollar spending. And if we were to get rid of a lot of the frivolous stuff that doesn't help move us forward, that would be a step in the right direction.
Yeah, and we talked once about some of the things that the government spends money on, and I remember one was, I think in Florida, they were using leaf blowers to see how lizards could hold on to trees. I don't know what that has to do with anything, but that was a huge amount of money that they were spending on things like that. If we cut out that wasteful spending, then possibly the taxes wouldn't have to be increased as much as they probably would have otherwise. But I think Mr. Trump does have another tax plan that doesn't involve probably raising or doubling taxes on people, does he?
Well, there's no amount of tax levying that you can do to fix the spending problem we have in this country. The rate at which we're spending money is not coverable under any tax scenario. If you were to raise taxes enough to cover the amount of spending going on, you would totally trash the economy and America would cease to exist.
Right.
And so there's no way to fix it by raising taxes. And I think anybody with a third grade understanding of economics understands that. And so the problem is we have to rein in spending, although I don't think Donald Trump will be the person to rein in spending any more than Kamala Harris will. But maybe that money will go somewhere that actually helps other people and helps our people instead of Ukraine and the Middle East and drag shows, etc.
Yeah, I've always thought that America can be the world's police force, but when it comes to spending, I understand basically two things are the biggest drain on the government spending, and that is Social Security and Medicare. Probably defense is in there too, right?
Right now, the debt service is also a massive one. Right now it's $1.2 trillion annually. And so because of that, it's like 75% of our total tax revenue. That's the elephant in the room right now. But you're right. Social Security, Medicare, those are the other ones that are always there. But the debt service is abnormally high right now because we've been refinancing a lot of this debt at 4 and 5%. So that's something that definitely needs to get tackled.
Right, and later on in the program, we'll talk a little bit more about Social Security, the possibility of what the COLA increase could be, the future of Social Security, etc. Boeing, boy, they have had some problems in the past few years. I understand they're now halting, I don't know if it's temporary, but probably temporarily halting the production of their Boeing 777s.
Yeah, so they were doing some testing on the 777X, to be specific. And they had a major engine. It didn't come apart, but it was starting to come apart. And so they're trying to figure out what the issue was. But yeah, I mean, it's the latest in a long line of quality control issues for Boeing that seem to be non-existent prior to about 5 years ago. But since then has been seemingly never not in the headlines for the last 3 or 4 years, although I'm sure there's been stints where they did okay. It just seems like every time you look at the news, there's something about Boeing in there.
Yeah, and I come from the Seattle area, at least having lived there for about 10 years or so. Boeing certainly is a very, very big employer in that part of the country and something that's very, very important to those people. But yeah, it was about maybe, 5 years ago when things began to go south. So hopefully they're going to get that under control. I think Boeing, do you think, has the lion's share of the airplane manufacturing business?
So it's basically a two dog race. It's Boeing and Airbus, I think, are the ones that they think they account for roughly, don't quote me on this, but it's about 80% of the total airplane manufacturing for commercial airliners. And those two are the big players. Now, Airbus has gained a lot on Boeing because of all these problems they've had. And airlines are tired of having egg on their face by using Boeing. And I can't say I blame them.
Yeah, I wouldn't be able to blame them either. So anyway, that's what's going on with Boeing, and let's continue here. I was in a Lowe's over the weekend trying to find some coveralls, and I couldn't find some coveralls in there. So it makes sense that Lowe's has seen a slowdown. If you don't sell coveralls, people are not going to come in the store, right?
Well, I'm not sure I'm ready to comment on that one, Jeff. We'll let that stand as you said it there.
Okay. Well, Lowe's anyway has seen a slowdown, and I don't know. I go into Lowe's all the time, but you're telling me, or at least I'm reading, that Lowe's has seen a slowdown. Is that not correct?
Yeah, so Lowe's has not seen one yet, but they see one on the horizon. So they're saying the second half of the year here, and obviously we're kind of getting toward the fourth quarter, but they're saying in the back half of the year that they think that consumer spending on housing is going to be lighter than what they had previously thought. And so it has some implications around a lot of different industries and a lot of different stocks. And so a lot of other retailers have not seen that same weakness, like Walmart, for example, reported earnings a couple weeks ago. And the earnings were stellar, very good. They saw a strengthening consumer and more spending. And so it may be relative to the housing market, although Home Depot they reported as well, and they did not see as much of a slowdown as Lowe's. So it could be just a Lowe's issue. It may be related directly to those coveralls, Jeff.
I think it's possible, too. And when I went in there, I was going to ask somebody, there's always somebody walking around, if you have coveralls, where would they be? But I didn't see as many people in the store. But still, I like to go to Lowe's. It's just one of those things. Hey, I don't need this, but there it is. Isn't that cool? I don't have the latest one, but anyway. I understand there's more tailwind to the weight loss drug market. What's going on there?
Yeah, Jeff. So Eli Lilly continues to knock it out of the park, and they recently had another government trial, another FDA trial, which was a long-term trial for the effects of these weight loss shots on the body. And they're saying that in the long-term trial, that it reduces the risk of diabetes, which, shocker, if you don't eat Oreos every night before you go to bed, you don't develop diabetes. And so the basic idea behind these shots is that it basically kills your appetite. And again, that's a little bit of an oversimplification, but it makes you feel full when you're not. And so you simply eat a lot less and a lot less often. And because of that, you lose weight. Now, the issue with that is in a lot of cases, there's significant muscle loss as well because you're not eating. And so you need to be a little careful with that. I'm not saying I'm pro or against these shots. I am saying that the vast majority of America would love to lose 10, 15, 50, 100 pounds.
Sure.
And so I think as soon as this gets approved for health insurance and or Medicare, I think we're going to see a lot of people take these shots. Now, right now, part of the reason I think we're not seeing that approval is because they wouldn't be able to handle it if they got it. Because right now they're already manufacturing as much as they possibly can. All the companies offering these drugs are building new plants to develop more as quickly as humanly possible. And so I think really in the next 2 or 3 years, you're probably going to see where we have maybe 40% of the population on something like this. Now, again, that's speculation on my part, but we can generally count on people to take the easy way out. Not saying it's necessarily a bad thing if you happen to be taking it, just simply saying that I think people would rather have a drug to help them lose weight as opposed to traditional diet and exercise and accountability and that kind of thing.
Yeah, well, why am I still doing it the old-fashioned way when I could take a shot? But, I can see what you're saying is that if we reduce obesity in the United States, probably a lot of other things will go down because there's so many diseases that are related to obesity, heart disease and high blood pressure, etc. So we'll see what happens here with this weight loss drug. Talking with Jake Floyd, Floyd Financial Group. Glad you could join us here for Show Me the Money. We're here for you each and every Saturday morning. We appreciate you being a part of our radio audience. If you like what we're talking about today, or you really have listened to the program and you say, Randy and Jake, pretty smart guys, I'd love to get in and sit down and talk with them, we are offering you the opportunity to do just that. If you'd like to have a casual conversation with Randy and Jake about your journey towards a confident retirement, no questions off limits, with no cost, no obligation, and no judgment, call this number 417-889-7233 and make that call this weekend. Leave your name and telephone number. Ashley will call you back during the week and set up an appointment that is convenient for you. Again, there's no cost. There is no obligation for this. I know you've got some questions about anything that relates to your retirement. Could be when to take Social Security, how to pay for long-term care, health care. Maybe you've got money in a 401k. You don't know what to do with it. You want to transfer it over to an IRA. you want to know what the choices are, you've got questions, we've got answers at Floyd Financial Group, and we'd love to help you out. 417-889-7233 is our telephone number. Make that call this weekend. You can also find out more about us online at floydfinancialgroup.com. Jake, time for a break. When we come back, we're going to be talking about the market panic and the recovery 3 weeks ago. All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about the market panic and recovery from 3 weeks ago.
That's right, Jake. And 3 weeks ago, that's all I read about or saw on the TV was market panic. It seems that people were, expecting the sky to fall. Did we overreact to what happened 3 weeks ago? And was what happened 3 weeks ago that uncommon?
So I think a lot of people did sell during that. I had quite a lot of clients call me, obviously, when they see the market going down, they see their money going down, especially as long as it's been since the market really went down. We had a lot of people that were concerned. They're like, should we just move all our money to cash and be safe? Whenever you have panic selling in the market like we did that day, which I talked about last week, exactly what caused that, understanding what caused it was forced selling on behalf of what we would call smart money, meaning the big hedge funds and pension funds and that kind of thing. As that was forced to unwind, they had to do a lot of selling as the market opened. And so especially where you have panic coupled with forced selling, that's usually the kind of day that you want to be buying something. What you want to buy depends kind of on the situation, but you don't want to be selling into that kind of pressure, because typically when you have overwhelming selling pressure like that in a single day or in a day or two, a lot of times the market gets very oversold very quickly. And what happens is they find a bottom and then the market starts to bounce. As it starts to bounce, all the algorithms kick in and all these high frequency traders start buying and buying and buying. And then you see a very rapid recovery like we did after that. So over the next 10 sessions after that Monday, the market regained over 90% of what it lost in like 10 sessions. So if you bought that day, which is easier to say than it is to do because money can be very emotional, but if you bought that day, you made a lot of money on an opportunity that you would not otherwise have had. But the biggest thing is we don't want to be selling into panic selling, because a lot of times you're selling near the bottom, at least of a short-term move like that. So as we're thinking about this in greater context, I think that it's likely we're going to see some more selling probably into the election at some point. There's going to be a lot of different things happening as we get into the election, as we've seen at both conventions, and there's a lot of things that could set people off. If there were to be other unforeseen events that impact the election outcome in the short term, going into September, which is already a historically weak month, and October, which tends to continue whatever happened in September, it could get kind of interesting. And so it's important that we remember that if there's more panic selling ahead of the election, a lot of times the right move there is to buy. I don't want to give blanket advice here, but what I do want to say is, generally speaking, you're rewarded for buying when everybody else is selling. As Warren Buffett, who is politically, again, I don't agree with Warren Buffett, but as it's very hard to deny he's the greatest investor of all time. And as he has said on many occasions, he said, when you have a day like that, you need to be in there buying when there's blood in the streets, especially when some of it is yours. That is very easy to say, much harder to do. But we want to focus in those situations on stocks or assets that are being unfairly sold. Because what happens is people, when they're panic selling, they throw everything out. They don't just throw out the bad stocks. They throw out the good stocks too. Case in point, like during 2020, Apple, let's say, and again, I'm not a huge fan of Apple in this current environment, but at the time in 2020, when we lock everybody in their houses, is that good or bad for Apple? Right? Everybody went out and bought new phones, new Macs, new iPads, all that. And that didn't stop the stock from going down 40% in 20 sessions. If you bought Apple while it was way down like that, you made a killing. I think that it's important to understand that certain stocks go down for a reason. Other times there are stocks or assets that get caught up in panic selling that, are being unfairly punished. And in those environments, you can buy them when they're on sale and potentially make yourself some money.
Jake, can we break it down as simply as more people were pushing the sell button than the buy button 3 weeks ago?
Yeah, that's pretty much at least more volume of shares, right? So you may have not had as many people, but the huge hedge funds that were unwinding their positions, were selling as much as 10,000 retail investors all at the same time. And so as they are selling and there's huge selling pressure, it also triggers algorithmic selling, or these high-frequency traders that use algorithms to buy and sell certain events. Let's say, hey, this stock went down 5%, so in our algorithm it says to sell it, so those get triggered and they start selling, and it creates this liquidity crisis where, like you said, everybody's pushing the sell button and almost nobody's pushing the buy button. At some point, everything will get bought, meaning if the price goes down enough, people will start buying. And so the question is, how far does that have to go down? And that can be, trying to catch the falling knife like that can be dangerous. However, if you're buying stocks or assets that you're willing to hold long term, they can be good buying opportunities for those types of assets.
And Jake, I know that you've been doing this, or at least you've been in your father's practice, which is your practice, of course, for 18, 19 years. I would imagine that you have seen market drops and market increases like this. How uncommon an occurrence, or how common an occurrence was what happened 3 weeks ago, and how can we prepare for these things?
So that type of selling does not happen very often, and it was really the unwinding of a 30-year trade. I would say what happened on that day was very rare. However, in general, liquidity selling like that is not as rare, but it's still maybe once a year, once every other year type of situation. And so almost always those turn into very good buying opportunities. And so it's important to not be too emotional about the money, even though, again, that's easier said than done, because this is, a lot of people's life savings and things like that. But that's why hiring an investment advisor can be a good thing, is if you can take the emotion out of it, overall, on average, you're going to be much better off. Because if you're too emotional about your money, when the market's down a lot, what do you want to do? You want to sell.
Sure.
But you should be buying, right? And then you sell at the bottom, and then the market starts racing back. You're like, how do I get in? And then about the time it looks good again, you get in, and then that's just in time for it to be at the top, and then it comes back down again. And so you're constantly doing the opposite of what you should be doing if you let emotion drive. That's where hiring a good investment advisor can help you out.
Yeah, somebody who can look at it without the emotional part of it. And I've said many times, it's the reason why doctors don't operate or work on their own family, because they can't take the emotion out of it. So there's another good reason to hire an investment advisor. Upcoming volatility, Jake, I know that you guys don't have a crystal ball. At least I sent Randy one, but it was defective right from the start, was never able to forecast the future with it. But what about upcoming volatility? Is this something that we should look for more of in the future?
So I think over the next few months, we're likely to have a heightened volatility comparatively to what we had. Now, that's not saying a lot, because the previous 18 months, let's call it, have been some of the lowest volatility we have ever seen in the stock market. And so the VIX, which is the volatility index, also known as the fear gauge, has been at historic lows since October of 22 and onward. And so the reading was around 12 for a lot of this last year, which is very, very low. And so I do think we'll see increased volatility, but it's more of a return to something somewhat normal volatility instead of this ultra low volatility that we've been seeing. Again, ahead of the election, any attempt of either party to cheat, recount, recertify, uncertify will likely be met with market turmoil, just because the market doesn't like that uncertainty that comes with that. And so the longer we have to wait to understand who the president is going to be after November 5th, the more likely it is that the market's going to panic a little bit. In my opinion, regardless of who ends up as president, we will see the market go up on the other side. but it could be, a little bit of finding out who the president's going to be before we know that.
And Jake, for those people who missed last week's show, the election is going to be November the 5th, but when do you think we'll know who the president actually is?
Unfortunately, if I had to predict, if somebody gave me money and said you have to bet on exactly when we're going to know, I would say shortly after the first of the year. Now, wow. I hope I'm wrong, but I think that this will be incredibly highly contested, and everybody's going to be upset, and everybody's going to be thinking, this guy cheated, that guy cheated, and I'm not saying necessarily that's wrong. I'm just simply saying that it's very likely there's going to be a lot of contesting, recounting, recertifying, all that. And that is going to take a little bit of time. Now, again, I hope I'm wrong. I hope we know on the morning of the 6th who the president's going to be, but I'm doubting it.
All right, so we'll wait and see. Of course, got to be sworn in on January the 6th, so we better find out who's going to be the president before January the 5th, because they got to get their suits pressed or their whatever's going to happen there in order for the inauguration to happen. So let's wrap it up here. This market panic that people had 3 weeks ago, can you design a plan that does involve the market, Jake, so that when these things happen, they're a minor annoyance and not a life-changing event?
Absolutely, Jeff. And I think that having the right plan up front will also help you determine what to do in those situations. And if you have a plan that puts you in a position where you are not panicking every time there's a lot of selling like that, and that you are free to take advantage of those situations, that's going to be a better scenario than if we're constantly reacting and we're taking too much risk and everything hurts too bad, and then we can't be rational about our decision making. And so having the plan set up on the front end is actually the best way to combat the panic selling and being able to take advantage of those situations as they arise.
We're talking with Jake Floyd of Floyd Financial Group right here in Springfield. We're talking about the market and the economy, what happened 3 weeks ago. Jake, before we continue, I'm sure that our listeners may have some questions, so I want to talk to them directly. If you're listening to the program today and you're worried about the market volatility, you think maybe you've got too much exposure in the market, you want to eliminate emotional investing. You want to take advantage of the opportunities while they exist and buy low, sell high, that sort of thing. You've got questions? Well, we may have the answer for you. It is Floyd Financial Group's opportunity for you to come in and sit down and have a one-on-one conversation with Randy and Jake. To get yours, call 417-889-7233. Now remember, there's no cost for this. There's absolutely no obligation whatsoever. This is just a casual conversation, a chance for you to ask the questions that you need the answers to put you on a path towards a confident retirement. No questions off limits. You've got questions about when to take Social Security. You don't know how to pay for health care. You don't know what to do with this lump of money that's in a 401k. You want to put it in an IRA, but there's so many choices. As I said, you've got questions. Floyd Financial Group very well may have the answers that you need. Again, 417-889-7233 is the number to call. Go ahead and make that call this weekend while you're thinking about it. Leave your name and telephone number. Ashley will call you back during the week and find a time that's appropriate for you to come in and sit down with us. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Okay, Jake, time for another break. When we come back, we'll talk about everybody's almost favorite subject, Social Security and the COLA increase. All that and more when our show continues right here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. In this segment, we'll be talking about Social Security, the COLA, and much more.
That's right, Jake, and the COLA's been on everyone's minds lately because it's been in the news. We've gotten a little bit of a head start with this. Generally, the COLA, I don't think, is released until sometime in October, but I've seen some figures that have been floated around out there about the cost of living adjustment. Jake, can you enlighten us a little bit about that, what it possibly could be or what it's more likely to be this year?
Yeah, so I would think that the COLA will be somewhere between 2.4 and 2.7% for the year. That's based on some estimates of other people, obviously, but I think that's very likely that that will be the number based on the CPI numbers that we've seen. As you've said, that number comes out in October normally for the official number, but there's been some preliminary estimates. And while that is not as big an increase as we have seen in the past, it's actually still a little bit bigger than the average Social Security increase. And that coupled with the previous 3 or 4 increases that we've had for Social Security have really added some extra strain to the system that's already underfunded. And so while it's nice to have the extra money in income for people on Social Security, we do have to start to wonder and be a little bit concerned about what it's doing to the Social Security system as a whole.
Yeah, and I want to talk about that, but you brought up a very important point, Jake, is if you think about this, let's say it's 2.5%, maybe we've had 2.5% for 3 other years here, so 2.5 times 4 is like 10, and then we had the big one there. I mean, really, in the past 4 or 5 years, we've had a significant increase in Social Security, haven't we?
Yeah, so over the last few years, it's definitely been elevated. So in 2021, the COLA increase was 5.9. Wow. In 2022, it was 8.7. In 23, it was 3.2. And then it's likely to be 2.5 or so, let's call it. That never comes out of the numbers. And so every number after this, every COLA is stacked on top of that inflation. Right. And so a system that was already going to be broke by 2035 or 6 is now going to be broke more like 2033 because of the added spending. But everybody that's on Social Security and everybody that's even ever signed up or ever will sign up has a permanent COLA increase in there of about almost 20% that we didn't normally have during that time frame. And so all those numbers are 20% higher forever. Yeah. And so I'm not sure that people quite understand the magnitude of that. It's likely that Social Security is going to get cut. Now, how it gets cut and on who is the question. On whom, I should say. And that's going to be a big debate over the coming years.
And a lot of people, still, as much as we talk about this, Social Security is misunderstood as to when to take it. The argument for taking it at 62, I hear from a lot of people, is that it is not going to be there. I'd better take it while there is something. But if I'm hearing you correctly, Jake, for those of us who are in Social Security age at this point, but let's say that the people listening to us who are over the age of, let's say, 50, 55 years of age, do you think that they're going to see any cuts whatsoever in their lifetime?
So I think it's a little bit too early to speculate whether or not we will see any cuts at all. I would say that the average person is likely to not be affected by any cuts that Congress puts in. Now, that's total speculation on my part because they really haven't talked a lot about this. But what we do know is we can count on politicians to be self-serving and self-interested as a whole. They want to get reelected. And so a plan that cuts everybody's Social Security by 20% will ensure that that person never gets elected again. Right. We can be pretty sure and count on their greed or whatever we want to call it to be reelected that will likely not be the way they do it. Most likely what they will do is they will increase the cap on which you pay Social Security tax. So right now that number is about $180,000. If you make more than $180,000, you stop paying Social Security tax. And so if they were to raise that cap to $1 million or $10 million or something like that in income, there would be a few percent of people paying most of the way for the Social Security rework. I think at the same time, they will kick the can on people that are probably 50 and younger as far as how old you have to be for full retirement age and maybe even how early you can file as early. Maybe you can't do 62 anymore. Maybe you could do 65 as early and 70 as normal. And then people that are, 40 and younger might have to be 85 to get it. There's a lot of ways they could go about fixing it. When they put Social Security into place, the average life expectancy was 67.
Right.
And you had to be 65 to get it. That tells you that they never planned to pay any money out of this and just use it for a slush fund, which is part of the reason it's broken. But now we have life expectancy that's 20 years after full retirement age. And that really starts to, especially once you're 65, if you're a couple living to 65, you have a better than average chance of one of you living to be 90, which is, obviously a lot longer than 67. And so the system is just kind of broken. How they fix it will be the real question. But I do think it's likely it will be means tested or it will be a tax on the wealthy.
Okay, so when you say means tested, what do you mean by that? If you have a certain net worth, if you have a certain income, that you won't get as much Social Security?
Yeah, so either one of those or both. So let's say you have passive income of $150,000 a year in retirement, you have a big pension plus Social Security or something like that. Maybe they reduce yours because you have so much guaranteed income. Or let's say you have $1 million in the bank and they'll say, hey, you don't have a lot of income, but you do have a lot of assets. And so because you have all these assets, we're going to cut your Social Security. And so again, I'm not a proponent of any of this, by the way, in case anybody's listening thinking, wow, he's pretty crazy, right? I mean, it's not fair.
Yeah,
this money's already been taxed. You already paid it in there. The fact that you even have to pay tax on it again is already unfair. And the fact that they might cut it in favor of somebody who has not paid as much in is lunacy, in my opinion. However, I am the messenger, so don't shoot me. I'm just simply saying that Social Security will have to get cut at some point. I do not think Social Security is going to go away, and I think the vast majority of people will be unaffected. Even if they replace Social Security with something entirely new, I think it'll be basically the same thing because they know how many people are depending on it, and we can depend on them depending on the votes of people to make sure that the vast majority of people are unaffected.
Jake, presidential candidates, have they addressed Social Security? Do you know? I think I've seen some headlines that maybe Trump has talked about maybe not taxing Social Security. Am I wrong about that?
Yeah, so that's been talked about. The amount of tax paid on Social Security is not a big number because the average person only pays tax on 50% of their Social Security anyway. Only 50% is taxable. There's a lot of people that pay no tax on Social Security. And so cutting the Social Security tax out would not affect tax revenue that much. I don't have the exact number in front of me, but it would probably be like 5 to 7% cut in overall tax revenue, which is a big number, but it's not a huge number, especially comparatively what it would do for the average person on Social Security. It would be a huge increase to their income as a percentage. It's kind of like the tips, right? The no tax on tips is kind of brilliant from the right side, from Trump or whoever actually came up with that idea, because a lot of the people that work in that industry as servers are more liberal of persuasion. The amount of taxes that's being paid on tips right now is very, very little. Part of the reason for that is it's kind of an industry where it's generally accepted that you don't report all your taxes, all your tips. And so, again, I'm not advocating that, just saying that's kind of the way of the world. It doesn't affect tax revenue much, but it does affect a lot of people. And so from a policy standpoint, that's a very smart thing to do on Trump's part or on his campaign's part. But I think looking at Social Security, it's going to affect almost everybody at some point. And I really think that Congress will try to do it in a way that has as little red tape as possible and that affects as few people paying in as possible, so that way they can be the champion. And I think that the only person that's really talked about cutting Social Security, to my knowledge, is Chris Christie, who called for a 20% cut across the board.
Wow.
That's probably why he has like a 7% likability rating. Or that's part of the reason. There's other reasons too. But he might be the most hated person in politics. I haven't heard of anybody that has as low a likability rating as he has in his home state and other places. But I really think that there will be a creative way to do it. Again, not one that I necessarily agree with, but it'll likely be a take from the rich and give to the poor scenario to try to fix Social Security. If you are worried about a cut, one of the things I've speculated before, and again, this is total speculation, but the way the government likes to work, like I said, they don't like as little red tape as possible. So I think it's likely that if they were to do an actual cut to Social Security, where they say, hey, we're going to cut everybody's 5% or 10% or whatever, likely the way they would do that is they would say, hey, if you have already elected and made all your retirement plans and everything based on this current Social Security number, and you retired, let's just throw out a number, 2 years ago or more, then yours is going to be unaffected. But everybody looking forward will be affected. And so electing early to protect a little bit against that could make sense. But you need to make sure that you're actually retired, because you don't want to be paying back into Social Security if you retire early and you're making too much income. There's a lot of factors to consider here. But if you are actually retired, even if you're not necessarily needing Social Security, the case could be made to take that money, invest it, and keep it on the sidelines. Again, that's something we can talk about if and when you come in for your consultation.
And that's the big question, Jake. I think people listening to the program today who haven't heard our past programs is, when should I take Social Security? Even if you don't need it, am I hearing you correctly in that if you took it at 62, you don't need it, you could take that money and invest it. But still, there are some limitations if you take it at 62 and you're still working.
Right. So you're limited to make, in this year, it's $22,530 or something like that. And so if you're still working full time, it probably doesn't make sense to turn on Social Security early. However, if you're retired, what, in my opinion, doesn't make sense is to spend your money while not spending Social Security's money, because all you're going to do is spend your money down, which gives you less options. I would rather spend Social Security's money and grow your money so that later in life you have more options, because you have more money at your disposal. And so we want you to have the control as the retiree, not Social Security. Anything we can do to not put ourselves at the mercy of the government, I think is a good thing.
And Jake, as I said, I'm sure people have questions about Social Security. They've got a lot of questions about retirement planning, how they can maximize their Social Security, not leave all this money on the table. And for those people, I'm talking to you right now. If you do have those questions about Social Security or really anything that has to do with retirement, you're not sure when to take Social Security, whether you want to turn it on, turn it off, you don't know about spousal benefits, anything like that, call us here at Floyd Financial Group. Our number, 417-889-7233. Make that call this weekend if you want, and Ashley will call you back during the week. She'll set up a time for you to come in and sit down with Randy and or Jake and ask the questions that you need the answers to. Again, there's no cost. There is no obligation for this whatsoever. And as always, there is no judgment. 417-889-7233 is our telephone number. Take advantage of this opportunity this weekend. So make that call, 417-889-7233. You can also find out more about us online at FloydFinancialGroup.com. Jake, time for a break. When we come back, we'll talk about bonds and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this last segment, we're going to be talking about bonds and bond strategies.
And we'll talk about at least 5 popular strategies for building a bond portfolio. Jake, have bonds become more in favor recently as a result of interest rates? Or basically, how do interest rates affect bonds?
Yeah, so the fact that interest rates are higher now with an outlook of potentially decreasing interest rates puts bonds in a good position, in a position where they're attractive, in my opinion, for the first time in literally like 15 years. When interest rates are really low and we own bonds, not only are we not getting a lot of interest, but it puts us potentially at risk, interest rate risk. If interest rates go up, bonds can get devalued if we need to liquidate them early. And so for a long time, bonds have not been particularly attractive, in my opinion. And if we look at the 10-year historical return on an average bond portfolio, it's around 20%, 22% cumulative, not per year, but 1.5% to 2% compound annualized return. And so not very good in a situation where the market's up like 600%. But now, as with any asset class or anytime something crashes, it becomes an opportunity. And so bonds had what would be classified by just about anybody as a crash in 2022. On the back end of that, when interest rates spiked, we kind of got to a high point, and bonds have been going up since then. And so I think that if we think that interest rates are going to continue to fall, that puts bonds in a relatively attractive position.
Now, we have talked about municipal bonds, corporate bonds. There are different types of bonds. Do the things that we're going to talk about here apply to both municipal, corporate bonds, bond funds?
Yes, Jeff, to some extent. Different types of bonds are more interest rate sensitive or less interest rate sensitive, more risky or less risky. But in general, those principles apply to all bonds, just some more than others. So treasuries or government bonds typically are more interest rate sensitive than corporate bonds. Municipal bonds have a lower interest rate, but they are tax exempt at the federal level and potentially the state level if you have a bond that's issued for the state of Missouri, either a municipality in the state of Missouri or the state of Missouri. And so there's a lot of considerations to decide what types of bonds to talk about. Last week, we kind of unpacked a lot of that, and that's something we can talk about in here. But focusing on the strategies, there's a lot of different ways to hold bonds or use bonds as a tool.
All right, so let's talk about some of the top strategies for your bond portfolio. The first one is called buy to hold. What is that, and what are the advantages?
Yeah, so this is kind of the most simple one, where we go out, we find an individual bond that we want. Let's say we have a government treasury that's 3 years in term and it pays 3.5%, let's say, right? And so that means that the government gets to borrow your money for the 3-year term, and they pay you 3.5% in interest. And then at the end of the term, you get your money back. And so you just buy that bond, you hold it, and then they cash you out at the end of 3 years. That's how the buy to hold or buy and hold, that strategy works.
Now, one of the big advantages of this, I understand, is that you eliminate liquidity. Is that right?
So in theory, you can sell in the middle, but you're going to be at the mercy of whatever the price is in the middle. And so if your goal is to hold it and you make that decision up front, then that would mean, that money stays there for 3 years. In theory, though, if you're holding that bond, you could sell it at any time, but what that price would be is going to be entirely at the mercy of what the bond market is doing, both interest rate wise and risk wise.
And did you say that the buy to hold is the most popular way to use bonds in a portfolio?
I would say in today's world, probably the most popular way is the ETF.
And what you mean by that is exchange traded fund.
This is probably the second most popular one, where people just buy bonds and hold them. It used to be back in the 80s and 90s and even early 2000s, a lot of people had individual bond portfolios. I will tell you that in today's world, I probably see 1 or 2 a year of people that I talk to that have individual bonds in their portfolio. It's not nearly as common as it used to be.
Okay, so our first strategy here for bonds is buy to hold. The next one is a bond ladder. Can you tell us more about that?
Yeah, so bond laddering is where we buy multiple bonds and we spread out the interest rate risk and the time, the duration is what we call it, risk, by buying several different bonds of several different time frames. So let's say that we have a bond that expires in 1 year, one that's at 3 years, one that's at 5 years. And this can be done for income purposes, meaning at the end of each year, you have one that expires in order to pay you your income, or it can be done for risk reasons. There's a lot of different ways to do it, but the idea of bond laddering is to have several bonds that expire at different times.
Okay, so the next one here is called bond barbells. Now, I've got a visual image of that. How do these work?
Again, the visual image of a barbell is pretty much how it works. So you have some short-dated bonds and some long-dated bonds, but you don't really have any midterm dated bonds. So maybe you have some 3-year bonds and you have some 15-year bonds, but you don't have any 5, 7, 10-year bonds. And so the idea behind that is that as time goes forward, every time your shorter bonds expire, you can buy more short bonds, and then it kind of moves that barbell forward as time moves on. I would say that this approach is maybe a little bit less, this is probably the least popular, probably not something the average investor has a lot of business doing because they may not understand the implications of what they're doing and the amount of risk that they may be taking on long-dated bonds. But it kind of depends on the investor and whether they're willing to hold those bonds if they get devalued. But they need to understand that there can be significant price appreciation or depreciation on long-dated bonds.
And the next bond strategy, Jake, is going to be bond bullets. How do they work and how common a strategy are they?
Yeah, so the bullet strategy is a form of laddering where all your bonds, you have different lengths, but they all expire on the same date. So let's say we have a 1-year bond, a 2-year bond, a 3-year bond, a 4-year bond, a 5-year bond. But what happens is we have those laddered in a way where we buy all these bonds on different dates, but they have the same expiration date. And so we mitigate some of our risk as far as how long dated these bonds are, but the money is then all available on the same day. So for example, let's say you wanted to use those bonds 3 years from now to purchase a house or have a down payment on a house, right? And so all that money would become available on that date. Again, not a very popular strategy. There's some very specific reasons why you might want to do that, but not something I see very much of.
And earlier we mentioned bond exchange traded funds. What are they? When should we use an exchange traded fund or an ETF?
Yeah, so a bond ETF is basically a packaged investment like a mutual fund. And you can have these inside mutual fund wrappers as well. But a bond ETF trades on the open market, and it's a package of bonds. And so a lot of times with ETFs, you have different types of bonds packaged together. So let's say we have only long dated bonds, but there's 500 or 600 different bonds in there, but they're all 15, 20, 25 years in expiration. So that would be like a long-term bond ETF. Or you might have a short-term bond ETF where they all expire in 1 to 3 years from now. You might have a corporate bond ETF that doesn't have any treasuries and only has corporate bonds. You might have a junk bond ETF where you have less credit-worthy companies that pay higher interest, but you're willing to take that risk for a higher interest payment. And so it's a way to kind of go like you're going to Baskin Robbins, right? You have 31 flavors, except in this case you probably have 3,100 flavors if you really wanted to, because there's a lot of different bond ETFs out there and bond funds. The nice thing about the funds, though, is that it gives you total liquidity in any moment, meaning you could just sell that ETF and then you have your money. You don't have to worry necessarily about when those bonds are going to mature because they're always rolling new bonds into there. Now, those prices can definitely go up and down inside the ETF based on what those bonds inside are worth. But usually the liquidity and the simplicity of buying a bond ETF really makes it the popular choice in today's world. And so if you have a 60-40 portfolio, you'll likely have some stocks or some mutual funds, ETFs that are equities, and then probably 95% of the portfolios I see are going to use bond ETFs or bond mutual funds to round out the bond or the income portion of the portfolio.
So, Jake, let's talk about the bottom line with bonds. What should people know about bonds as far as liquidity? They're really not very liquid, are they?
So, again, this is a little bit of a delicate subject. So basically, bonds are liquid because almost all bonds can be sold at any moment. However, you are at the mercy of what those are worth. I think a lot of people think of bonds where they think of it like the buy to hold strategy, meaning I buy a bond that's 3 years, so I have to hold it for 3 years. You can liquidate that bond at any time. What the price is for that bond in the middle can definitely fluctuate. And so I would say that buying individual bonds, there's a place for that, but you need to understand the implications of what kinds of bonds you're buying. Versus if you're buying an ETF, you have a well-diversified bond portfolio. If you're buying one bond or two bonds, you obviously have the same problem that you have when you're buying one or two stocks, right? You want to have a diversified portfolio of bonds just like you want to have one in stocks. So it's not correct to say that it's illiquid. What I would say is there are extra implications to be aware of when it comes to liquidity of a bond. In this particular case, if interest rates go up when you're holding a bond, likely your bond will be devalued. If interest rates go down while you're holding a bond, you might be able to sell that bond for more than you paid for it, which whether or not that's appropriate kind of depends on your overall strategy, how much it's up or down. And again, that's where a financial advisor can come in handy.
Well, I'm glad you cleared that up, Jake, because I always thought that bonds were not as liquid as the stock market, but you're saying that they certainly can be with some caveats. So what should people generally know about bonds? When are bonds a good thing to put in a portfolio and for what use?
Yeah, so I really think bonds are attractive for the first time in a long time right now. We have not used a lot of bonds for the last 13 to 15 years because the risk versus reward profile was not good. However, we recently have been adding some bonds to portfolios because we like the idea of getting 4 or 5% interest and then also potentially having increasing value of those bonds as interest rates fall. Our base case, meaning what we think is going to happen, is we think interest rates will come down pretty much no matter what for different reasons, maybe depending on who gets elected, but interest rates will likely come down either way. And so we like the setup of the fact that we're getting good interest and we might even get some appreciation as interest rates come down.
Jake, if our listeners have questions about bonds or pretty much anything else in their portfolio, certainly they can give us a call here at Floyd Financial Group at 417-889-7233. We're standing by to take your call. Go ahead and make that call this weekend, 417-889-7233. All you got to do is leave your name and your telephone number. It'll take you less than 60 seconds to do that. Ashley will give you a call back during the week and set up a time for you to come in that's convenient for you to talk to Randy and or Jake here at Floyd Financial Group. Ask your questions about bonds. You can talk about Social Security. You can talk about the stock market. You can talk about pretty much anything that comes to mind that has to do with your journey towards a confident retirement. There's no cost and there is no obligation for this whatsoever. Again, it's a casual conversation. Totally non-judgmental. We'll meet you where you are. 417-889-7233 is our number. You can also find out more about us online at FloydFinancialGroup.com. Jake, we're out of time for this week. I want to thank you for your time, but most importantly, I want to thank the best listeners in the world, our listeners here to Show Me the Money on KSGF. So for Jake Floyd, I'm Jeff Shade. Have a great weekend. Talk to you again next week right here with another edition of Show Me the Money on 104.1 FM, KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor registered in the state of Missouri.